Welcome to Blind Squirrel Macro the Pod, our usual companion to the weekly newsletter. Squirrel coming to you from the Mornington Peninsula this chilly morning, Tuesday the 24th of September. Quick reminder to make sure you get the show notes for the charts and the links, and if you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. Before we start, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent. Talk to a financial advisor. Now this week, this piece is called Contemplating the Defensive Puzzle. As a long-term uranium bull, the breaking news last Friday that Constellation Energy was planning to apply to restart Pennsylvania's 3 Mile Island nuclear facility was undoubtedly bullish news. The fact that this move was facilitated by a jumbo 20-year purchase agreement to power Microsoft's AI data centers was somewhat inevitable. The squirrel has been puzzled by the utilities as AI stonks narrative that's been advanced this past year. However, back in April, I conceded that our West Coast-based tech overlords have finally woken up to the fact that their new AI toys are going to require more electrical power than the grid has to offer them. I was then struggling, and still do if I'm honest, to see how this realization would be a universal positive for the electricity generation sector. Of course, certain IPPs or independent power producers such as Constellation and Vistra could serve a role in meeting the increased demand from AI's large language models, but the rest of the sector would struggle to capitalize on the theme with their regulated assets. As such, we've been short the US utilities via the XLU ETF since May. To be honest, this hasn't been so much fun so far, but I continue to think there is still strong merit in the thesis, especially at the end of a week in which the long bond bulls had not received their first rate cut fireworks that they were possibly expecting. More on that later. I'd expected a short-lived bullish reaction to the news from the Utes again. Apologies to my Aussie readers who thinks that the squirrel is constantly obsessing about pickup trucks. I mean Utes as in utilities, not as in cars. We do, however, live in the age of market extrapolation, and I woke up on Saturday morning to see that the entire utility sector had run like it had just stolen something. Constellation, up already over 100% on the year, had quietly tacked on 22% to its market cap during the Friday session while I slept. Now, this came to the consternation of even someone who puts the word nuke in their Twitter handle. At JG_nuke pointed out that Constellation had added a cool $13 billion to its market cap on Friday. That's almost the price tag of building a brand new reactor. To be fair, the numbers he references are actually the original estimated construction cost for Georgia Power's new reactors. The final cost was more than double those numbers, but that is a conversation for a different day. It also takes nothing away from the wildness of the move. To say that US utility stocks have been suffering from a bit of an identity crisis this past year would be an understatement. In recent weeks, they've been struggling to decide whether they are, 1, an integral part of our AI-powered future, or 2, a safe equity sector in which to hide as we enter a slowing economy, in need of the support of those easier monetary conditions that we saw last week. This brings us on to last Wednesday's rate cut from the Federal Reserve. Regular readers of The Rodent will know that I have been concerned that the investors crowded into long-duration fixed income investors, such as the TLT ETF, would be disappointed by the reaction of the long bond to Mr. Powell's first cut. This turned out to be the case. To butcher the words of Obi-Wan Kenobi, the squirrel felt a great disturbance in the St. Bart's, as if millions of voices suddenly cried out in terror and were suddenly silenced. Sorry about that. That little inside joke was for the benefit of approximately 3 of you, but if you're desperate for an explainer, please message me. Now, this rodent does not consider himself sufficiently qualified to judge whether or not the Fed has made a policy error, in inverted commas, by cutting rates so forcefully with growth still above trend and inflation still well above target. Central bankers will be rated in due course, with the usual 50-50 hindsight. Now, what I do know is that 1, long-duration yields do not appear to be completely relaxed about the long-term outlook for inflation, and that 2, risk assets clearly love the look of that rate cut. Now, I hear the strong arguments about low-income consumer weakness and the ongoing fragility in rate-sensitive sectors like commercial real estate. However, at the headline levels of growth and employment, it's a struggle to find a data point that points to near-term recession. Although last week's FedEx numbers and earnings call, I quote, "weakness in the industrial economy pressured our B2B volumes," did raise this squirrel's eyebrow. With record fiscal deficits and now monetary easing driving the US economy, this new love for risk should clearly not be fought. Then, of course, we have a presidential election in November to bear in mind. The White House may indeed look too close to call, but a risk-negative sweep by either party now appears to be much less likely than it was earlier this summer, at least as per Polymarket odds. While odds favour gridlock, politics should not force investors onto the sidelines. Does that mean we should all be piling back into profitless tech companies or the latest meme coin in the cryptosphere? Should the squirrel be swallowing his pride and waving the white flag of surrender and joining the crowds chasing the AI dream with the large cap hyperscaler stocks? Well, by all means you do you, if that's your thing. This rodent is a great believer in regret minimization. To lose money having been a late arrival at the profitless technology and AI equity party would be inexcusable, not to mention a source of plenty of regret. We've spent much of this year thinking about the role and nature of the classic defensive equity sectors for this market cycle. In April, I ran through the reasons why the so-called defensives might struggle to play their traditional portfolio role in the event of an economic soft patch. That piece was called "Dead Generals Out, Grandpa's Defensives In?" If we're not indeed staring down the barrel of a weaker economic growth backdrop, holders of this exposure find themselves at risk of owning assets at peak cycle valuations with heightened risk of becoming political footballs and strategic moats that are significantly narrower and shallower than they used to be. You're also at risk of having way too much company alongside you in these assets, just as we appear to be entering a pro-cyclical market regime. MC, new friend and author of Macro Charts, included a great slide in his excellent piece from last Thursday, which I put in the notes. The extreme flows from cyclical to defensive equity assets appear exaggerated relative to the recent pullback in long-term treasury yields, which, as you know, the squirrel thinks could well be overdone themselves. Bank of America's most recent fund manager survey also highlights the recent acceleration in this trend. The imbalance between cyclical and defensive is now the highest it's been since May of 2020. After the recent acceleration, defensives, that's utilities, staples and healthcare, have outperformed cyclicals, that's mining, materials, energy and industrials, by almost 8% year to date. You can add a further 10% of that to that outperformance number if you want to look at the utilities in isolation, up 28% on the year. I suspect that we're already at peak shine for the sparkly AI data center narrative as relates to utilities. Remember that this luster only applies to the independent power players, those unconstrained by regulated assets. The consumer staples and healthcare sectors are also now trading at racy premia to long-term average multiples if portfolios are indeed incorrectly positioned for economic headwinds. The narrative and valuation arguments for a portfolio rotation away from defensives and into cyclicals are compelling, but is your rodent in danger of overthinking it? If we're in risk-on mode, why not just pile back into the market cap-weighted indices dominated by the technology giants? Well, without re-rehearsing all of the arguments, the squirrel's views are largely unchanged from my "it ain't necessarily so" piece from earlier in the year. I believe that the risk of investors taking fright over perceived capex malinvestment by the AI hyperscalers is still very high. I also worry that large cap technology stocks are precisely where many of the foreign investment flows have been hiding in recent years, a trend that has only accelerated since the pandemic. Yet, so far, we already have one presidential ticket that is advocating the potential taxation of foreign investment assets in the US. With the race as it currently stands, that really, truly terrible idea, and I do not just say that as a regular foreign investor in US assets, would end up on the second ticket in a heartbeat if it looked like it might garner some votes in a close race. It certainly did not escape this rodent's notice that while US equities had a decent Fed week last week, most of the rest of the world's equity markets had an even better one. Will foreign capital soon start to go home? Now, it feels as though the risk-reward of a late chase of the market leaders of the past decade stacks up unfavourably when compared with the opportunity in more classically cyclical sectors. The squirrel already has a reasonable amount of cyclical exposure, energy, commodities, emerging markets, etc. in the portfolio. However, we plan on making some room for some more. In section 2 of this week's letter, we sketch out part of that plan. My rodent whiskers are twitching, and my pal MC's technical launch signals are screaming at him. On that note, he and I are recording a special podcast for subscribers on this potential asset rotation tomorrow evening. We'll release it into your feeds later in the week. MC has traded global macro assets on the sell and buy sides, and we both started our careers in the markets in the early 1990s. I'm sure it'll be a great conversation and hope that it'll be a regular collaboration. Get that and more regular snark at blindsquirrelmacro.com or find me on Twitter @squirrelmacro. Thank you again for listening. Squirrel out.